Welcome back. In the last lecture, we talked about interest rate in stock index futures, and we discussed how by taking positions in stock index futures, we could manage the systematic risk of a portfolio. By taking opposite positions, we can reduce the beta of the portfolio, and by taking parallel positions, we can increase the beta of the portfolio. We also talked about the concept of arbitrage in the context of stock index futures, how cost and carry arbitrage can take place and how reverse cost and carry arbitrage can take place. We also discussed arbitrage involving transaction costs, where there was spread between bid and ask, and there was spread between borrowing and lending rates. Today, we move on to the next topic. We introduce the concept of interest rate futures, but before talking about interest rate futures, a few preliminaries, a few prerequisites. Prerequisites would cover the underlying concepts of interest rates and the description, the capturing of the risk entailed by the fluctuations in interest rates on the due to the impact on instruments trading in the market, fixed income instruments trading in the market. So, let us start with it. Basics of interest rates. The first thing obviously is the spot rate. What is the spot rate? The spot rate is the rate at which, when you make a deposit as of today, the rate that you get in a particular investment, fixed income investment, is what is called a spot rate. Suppose you want to make an investment for 6 months starting today, the rate that you are going to get is called the spot rate. If the investment is made today, that is the important part. Technically, the spot rates constitute the yield to maturity on instruments which are zero coupon bonds of the same maturity as the rates are intended to be obtained. For example, if you want a 6-month spot rate, we look at the yield to maturity of zero coupon bond which is trading in the market with a maturity of 6 months. Similarly, if you are looking at the spot rate for a 1-year deposit, we look at the yield to maturity of a zero coupon bond with a maturity of 1 year and look at the price that it is trading at to work out the yield to maturity. That is the technical definition of a spot rate. Spot rate is the yield to maturity on bonds that pay only one cash flow to the investor and whose maturity coincides with the maturity for which the spot rates are to be calculated. Usually, spot rates are worked out for 6 monthly intervals rather than annual intervals, and then annualized to obtain the spot rate for the for the annual description, per annum description of the interest rate. The next question arises, we are talking about yield to maturity. So, let us understand what is yield to maturity. Yield to maturity is that discount rate, it is that discount rate which equates the present value of all future cash flows attributable to a particular share, particular security to its current price. That discount rate at which all the cash flows emerging from that fixed income security emerging from the bond are equal to the current price at which the bond is being traded in the market. In other words, it is the value of y, it is the value of y that satisfies this equation. P naught is equal to the summation of present values of all future cash flows. These are the cash flows and these are the discounting factors. For a single coupon for a zero coupon bond which gives you only one cash flow at maturity, obviously there is only one cash flow. So, this formula simplifies to this expression P naught is equal to f into 1 plus y to the power t, and this is also the definition of the spot rate for the maturity t. Therefore, we have y is equal to S0 t. S0 means is today's rate for the investment that you are making as of today. So, to recap, spot rates of a particular maturity are the YTMs and zero coupon bonds of the maturity for which the interest rates are being quoted. P0 is equal to f upon this, and this This implies y is equal to S0t. Let us take an example to illustrate what we have discussed just now. We have 3 bonds A, B and C. Face value of each bond is 1000. Bond A is a 0 coupon bond that redeems at face value, that is, it is trading at a discount and it is going to be redeemed at 1000 rupees at the end of a given period, the end of 2 years. Bond B is a par bond. Par bond means it is quoting at its face value. A par bond is a bond which is quoting in the market at face value. So, it is the present market price of the bond is 1000 rupees and it will be redeemed at the end of 2 years at 1000 rupees. It pays annual coupons, the interest rate is paid annually. Bond C is an annuity. Annuity means it will give you 2 equal payments at the end of year 1 and at the end of year 2. It is also quoting at 1000 rupees and in this case please note the redemption will not be at 1000 rupees, the redemption will be segregated into 2 parts, one at the end of the first year and at the second at the end of the second year, in such a way that the total cash flow, that is redemption value plus interest at the end of the first year and the total cash flow, that is redemption value plus interest at the end of the second year, are equal. The spot rates corresponding to 1 year maturity, that is, if you invest as of today for a 1 year deposit is 10% and if you invest for a 2 year deposit you get an interest rate of 15%. You have to work out the YTM of the 2 bonds. Now, this is the timeline 0, 1 and 2. The spot rate is given as 10% and 15%, 10% for the maturity of 1 year and 15% for the maturity of 2 years. Discount factor has been worked out by taking annual compounding. So, it is this is 1 upon 1.1 and this is 1 upon 1.15 whole square. So, bond A gives you a cash flow of 0 at the end of the first year, but it gives you a cash flow of 1000 at the end of the second year. It is redeemed at face value. So, its current market price is obtained by discounting these 2 cash flow, this cash flow and this cash flow, using these discount factors to arrive at this market price, and the YTM works out to 15%, which is interestingly the 2 year spot rate, because the entire cash flow, now this is what we mean by a 0 coupon bond. There is no cash flow in the first year, the entire cash flow is taking place at the end of the second year. It is redeemed at face value, it is quoting at a discount. This is the example of a 0 coupon bond, and as you can see, the YTM of this bond, which is 15%, is equal to the spot rate for the 2 year, at which point in time it is being redeemed. For bond B, the situation is slightly different. The situation is that it is quoting at a par value, that is, it is presently quoting at a market price of 1000 units, 1000 rupees, and if we work out the coupon percentages, it comes to be 14.64, 14.64%. The YTM also works out to 14.64%. Now, please note another thing here, the YTM lies between 10% and 15%. That is an important issue which we will be addressing later, but for the moment YTM lies between 10% and 15%, and the coupon rate in this case, another interesting observation, in this case, because the bond is being quoted at par, quoted at face value, the coupon rate is equaling the YTM. So, 2 important conclusions here, the YTM lies between the spot rates, the minimum spot rate and the maximum spot rate, the YTM lies between them, and number 2, if a bond is quoting at par value, then the coupon rates must coincide with the YTM. In the second case, we have an annuity bond. So, it is paying the same amount of money, 600.516 at the end of the first year, same amount 600.516 at the end of the second year. It is given that this bond is quoting at 1000 rupees, and again we find that the YTM lies between the 2 spot rates 10 and 15%. And another interesting observation that emanates from this discussion is that as the intermediate cash flow increases, now here it was 0, here it was 146 and here it was 600, the YTM tilts towards, the YTM moves towards the shorter term interest rates, which is natural, because the weightage given to this year's cash flow increases. Here the weightage is 0, here you are having a cash flow of 146 and here you are having a weightage of 600. So, therefore, in some sense this weightage contributes to the YTM tilting towards the first year rates from the second year rates, which was equal to the spot rate as in the case of bond A. So, some interesting observations. Now, the next question that we need to address is, why do we need YTM at all? Well, look at this example. It is a 2-year bond. The coupon rate is 15%. So, both the years I am getting 15%, 15%. The spot rates I have taken as 8% and 12% just for the sake of illustration. Let us take 1 year spot rate as 8%, the second year spot rate is 12%. The discount rate is worked out as in the previous case. Now, the difference between the two bonds is that in the case of bond A, the entire redemption is at the end of the second year. First year you get a coupon of 150 rupees on the face 15% on the face value of 1000 rupees. In the second case you get the redemption amount of 1000 rupees, that is the face value, plus 150 rupees of the second year's coupon, which is 15% of 1000 rupees. So, these are the two cash flows and the return a YTM of 11.72%. They return a YTM of 11.72% and a market price of 1056. Now, let us look at bond B. Now, please note, bond B is having the same coupon rate, but it is having a slightly different repayment structure. The repayment in bond B is split into two parts. 500 rupees is paid at the end of the first year, face value is 1000 rupees, 500 rupees is redeemed at the end of the first year and 500 rupees is redeemed at the end of the second year. For the first year you get the full interest because the entire amount is outstanding. So, you get 150 rupees, and in the second case the interest that you get is on the 500 rupees of remaining after redemption, that is 75 rupees. The interesting thing is that despite the coupon rate being the same, despite the spot rates being the same, we end up with a YTM which is significantly different from the YTM for bond A. Now, the question that the YTM attempts to answer here is, which bond is better? It is, if you do not consider the YTM, if you ignore this yellow column, it is very difficult to see, because the coupon rates are same, the spot rates are same. So, it is very difficult to make a judgment of which of the two bonds is better, or which of the two bonds constitutes a superior investment. So, YTM in this context comes to the rescue. YTM in the case of the first bond works out to 11.72%, in the second case it works out to 10.42%. So, in some sense you can say, you can argue at least that bond A is showing a higher, a superior interest rate or a superior return. For the moment, let us take return in the rough sense. We will be clarifying this concept of return as we move on. Now, just look at this. If you look at this expression, now please understand one thing. When you invest in a fixed income security, when you invest in a bond, you get coupons at various points in time. You get coupon, let us say it is an annual coupon bond. So, you get coupon at the end of the first year, you get a coupon at the end of the second year, you get a coupon at the end of the third year, and so on up to the life of the bond, when you get the redemption money and the final coupon payment. Let us call it C, let us call it CN, capital N. Now, the point here is since these coupons are coming or the cash flows are occurring at different points in time, and there is something called the term structure of interest rates. What is this term structure of interest rates? The term structure of interest rates says that interest rates, and it is empirically observed as such, this term structure is observed in practice, in reality, and therefore, it becomes relevant to the analysis. The term structure of interest rate states or says that the interest rates are a function of the maturity of the investment or maturity of the instrument. In other words, if you have a deposit of 1 year as of today, you make a deposit at the as of today for a maturity of 1 year, for a life of 1 year, you get a certain rate. It is not necessary that if you make a deposit of 2 years starting today, you get the same rate. You will probably get a slightly different rate. It is very common knowledge in the case of fixed deposits with banks. Banks generally have deposits rates varying with the maturities of the fixed deposits. Yes, same holds in the case of bonds as well, same holds in the case of market as well. The interest rates are a function of maturities of the deposits. For a given deposit, you have a certain interest rate, for a different maturity you have a certain different interest rate, for a third maturity you have a third. So, there is a spectrum. There is a spectrum of interest rates corresponding to different maturities, and that is what is called the term structure. Therefore, because when you invest in a bond, you get cash flows at different points in time, it becomes necessary to use different rates for discounting those cash flows to work out their present values. For example, in the case of cash flow occurring at the end of the first year, you will require a rate which is the first year spot rate S01. For a cash flow that occurs at the end of the second year, that has to be discounted at a rate of S02, and so on. So, every cash flow must or rather every discount rate must relate to the cash flow timing to make the discounting proper. Otherwise, the discounting is not going to be proper because of the issue of term structure of it, because you will be using different rates, different maturity rates corresponding to different timings of cash flows, which is wrong. Right. So, we arrive at the current price of the bond, that is the standard practice, as the present value of all future cash flows discounted at the respective spot rates. The current price as the present value, the aggregate present value of all future cash flows discounted at the appropriate spot rates, but by definition this P0 must be equal to this expression. That is the definition of yield to maturity, that the yield to maturity is that single rate. Now, this is very important, it is the single rate, it is that one rate which discounts all future cash flows and equates them to the current market price. So, we have two equations or two expressions for the price, one based on the spectrum of or the term structure of interest rates or the spectrum of interest rates corresponding to the timings of cash flows, and the second, that one single rate equaling the or discounting the cash flows to equal the current price. So, what does it mean? It means that this y captures the effect in some averaging sense. You see, this is one figure, here is a multitude of figures and they are doing the same job. So, this y must be in some sense an averaging of all these interest rates. In other words, this y provides in a single figure captures the essence or the average, not the conventional average, not the arithmetic average or whatever, but in some averaging sense it captures the effect of the term structure of interest rates into one single figure. And that is why it is sometimes interpreted as an average, as a proxy of the market interest, that one single interest rate that accounts for the entire term structure of interest rates. Now, another interesting thing, if you go back to this to the equation which defines the YTM. For example, let me write it down. P0 is equal to C1 upon 1 plus S01 plus, let us take a two period bond, 1 plus S02 whole square, maturity of 2 years, and this is equal to C1 upon 1 plus Y plus C2 upon 1 plus. The first thing that we observe from this is that given a certain structure, given S01 and S02, a spectrum of spot rates, given a spectrum of spot rates and the timings and amounts of cash flows, you determine the price uniquely, given C1 and C2 and their timings, and given the corresponding S01 and S02, you are given or you are able to determine a unique P naught. That is one thing, this is unique P naught, and having determined a unique P naught, you arrive at a unique Y. So, what is the net result? A given spectrum of spot rates, that is S01 and S02, and a pattern of cash flows, that is C1 and T2 with their timings, you determine the price uniquely, and once you determine the price uniquely, you also determine the YTM uniquely. So, there is a one-to-one correspondence, in fact, there is a one-to-one correspondence. For a particular bond, there is a one-to-one correspondence between the price and the YTM. What does it mean? It means that if I have a structure of cash flows given to me, then the price and price of that cash structure of cash flows and the YTM are in one-to-one correspondence. However, given a price or given a YTM, you cannot uniquely determine the spectrum of spot rates. In other words, if you are given a pattern of cash flows, if you are given a YTM, you determine the price uniquely, that is fine, but you cannot determine uniquely S01 and S02 or the entire spectrum of cash. You cannot uniquely determine the term structure of interest rates. Let us see an example. Look at this example. We have got one spot rate, S01 is 8%, S02 is 12%. And on that basis, I have a bond which gives me cash flows of 650 and 575, any bond which gives me this particular set of cash flows 650 and 575. 650 at the end of first year, 575 at the end of second year is a pattern of cash flows. Let us say it is encapsulated in a bond. So, these are the cash flows of a bond. If I work out the price of these bonds given the spectrum of interest rates, I get 1060, which translates to a YTM of 10.42%. 10.42% is the YTM, 1060 is the price. These are the interest rates for 1 year deposit, this is the interest rate for 2 year deposit, and this is the cash flows. What I have tried to establish here is that if I take instead of 8% and 12%, if I take 8.29% as H01, let us call it H01 star, and 11.80% at H02 star, I will still end up with the same price and therefore, the same YTM. So, two different pairs of interest rates give you the same YTM, give you the same price. So, the net result is that while the YTM and price are in one-to-one correspondence, YTM or price do not uniquely determine the spectrum of interest rates. This is a mathematical example or explanation of what we saw in the previous slide relating to a 2 year deposit, 2 year bond. Now, we come to YTM and bond price. As you can see here, there are certain interesting observations in this particular diagram. The first thing is very clear. This is the original graph, this is the mean graph, this one, the red line. The red line clearly shows that as YTM and price are inversely related. YTM increases, price decreases. YTM increases, price decreases. That is very obvious, because we have P0 is equal to summation C I upon 1 plus y to the power I. So, as YTM will increase, P0 will decrease, and vice versa. So, that is one thing, they are inversely related. The second thing is, if YTM is equal to coupon, then the price is equal to the par value of the bond. If YTM is equal to coupon, price is equal to par value of the bond. The third thing, if YTM is less than the coupon, then the price is more than the par value of the bond. What does it mean? Let us try to understand it. What did I say? I said that if YTM is less than the coupon, the price is more than the par value of the bond. Let us understand. As I just mentioned a couple of slides back, YTM is symptomatic, or YTM epitomizes the market rate in some sense. So, when I say YTM is less than the coupon, in effect what I am saying is that the average market rate for the life of the bond is less than the coupon rate of the bond. The coupon, the bond is giving me more cash flows than what the corresponding risk adjusted market rate demands. That is very important. The YTM is the market rate, market oriented rate, or market related rate, let us call it, and the coupon rate is what is given by the contracted by the contract of issue, but that is embedded in the contract of issue of the bond. Now, if the market rate is lower and the coupon rate is higher, that means what? That means investors are getting more from that instrument compared to what the market is desirous or market is providing basis on the basis of demand and supply. Investors are getting more from investing in that bond than the market rate, the aggregate rate. This implies what? This implies that they are getting better than what they should get or what they are expecting to get, and therefore, there would be an increase in the demand of this kind of instrument. When there is an increase in demand of this kind of instrument, it translates to an increase in price. If the bond is to quote at par, then YTM will equal the coupon rate. If YTM cannot change, if YTM cannot change, say YTM is dictated by market forces, so YTM will not change, then the price will adjust in such a way, that the coupon rate, when related to the value of the investment, which is the current market price, will give you the same YTM as the market rate. So, in effect, we end up with the situation where the market rate or the YTM and the market rate of the instrument coincide, and that is the state that will prevail at equilibrium. And now, we come to a very important issue. Okay, we will take it after the break. We will talk about the implied assumptions of YTM and how they relate to the utility of YTM as a measure of yield on a fixed income security. Thank you.